because I look at volatility in gold now as the highest it's been versus the S&P 500 since 2007. So it's no longer a store value. It's now a risk asset. If the stock market goes down, almost everything is going to go down. Commodities will go down less.
Commodities maybe haven't been top of mind for a lot of investors in recent years, but that has seemingly shifted. From inflation to geopolitics to the energy demands of AI, as some of the key forces we're seeing driving this asset class, it's getting harder to ignore. Today, we're looking at commodities and how investors can gain access in their investment portfolios, looking beyond just gold to a broader set of commodities. Before we get started, a quick reminder, this is not investment advice or recommendations. Today, we're providing education and information to Canadian DIY investors. Joining me today is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence, and Jim Wiederhold, Commodity Indices Product Manager at Bloomberg. Thank you both for being here today and welcome to the channel. Jim, let's start with you. Hoping you can dive into a little deeper some of the reasons why commodities seem to be back in the conversation right now after being underowned for so long.
Yeah, commodities have definitely been back in the conversation after market participants are now looking for diversification after a historic move higher in valuations in equity markets over the last few years. We've seen some investors chase the rally, but people are starting to understand that we may continue to see these bouts of volatility that have picked up over the last few years in the 2020s. So since the start of this decade, we're in a new macroeconomic regime as opposed to what we were in the 2010s. We have higher volatility, higher geopolitical risk, higher global temperatures, and higher inflation across the board. And that's all providing a solid backdrop for why you want a commodities allocation in a portfolio. So the prior decade was completely opposite of that. And you've seen people move away from the asset class. But now the Bloomberg Commodity Index, BCOM, broad commodities exposure, that has had good performance over the last 5 full years. The annualized performance has been over 10%. And people have been moving the asset class over the last 2 years or so. And it's because they're seeing the benefits on the diversification side as well as the recent performance and the momentum that's been building.
So investors really looking for that diversification sleeve in their portfolio. What would you say is one of the biggest misconceptions investors have about commodities as an asset class?
I'd say one of the biggest is the misconception that the asset class is very volatile. So some individual commodities are volatile. They tend to be more volatile than other individual stocks like natural gas and cocoa. But when you have a broad commodities exposure that's diversified, it has shown to have a similar volatility profile to equities over the last few years. And most investors, they want to avoid volatility. They look for the risk-adjusted returns. But when they have a long exposure, they're more concerned with the volatility of the downside. So they do want to see price appreciation, and they're comfortable with that upside volatility. And commodities are opposite in the pricing dynamics than equities in that case. I wrote a blog last year called "Commodities Take the Elevator Up and the Stairs Down." So when there's big price moves, it tends to be big price spikes in the commodities asset class due to supply disruptions, typically. But equities, when we have pickups in volatility, we see a big drop, and commodities do the opposite. So not only are they uncorrelated to other major asset classes, but they do it with bigger magnitudes of the upside historically. So one good thing about having the Bloomberg terminal in our history, we have the BCOM history going back to 1960. And I looked back at the top 10 best years, top 10 worst years for equities and commodities. And in the down years, commodities and equities tend to have similar average downside. But to the upside, commodities tended to outperform on average against equities by at least 10% in the best years, looking back over the 6 decades. So that just shows the added diversification benefits that you might get from commodities exposure. And I also did that over the best and worst quarters, and commodities had lower drawdowns in the worst quarters, and same thing, better upside on the outperforming quarters.
Very interesting. Mike, I want to bring you into the conversation. Let's turn to you as the Senior Commodity Strategist at Bloomberg Intelligence. Very interested to hear what the key themes you see are in terms of driving performance in the space into next year, and then what are areas within commodities that are standing out to you right now?
Well, I think let me compliment or maybe push back on some of the stuff that Jim said, mostly complimenting. One thing I have an affection for the BCOM commodity index is I managed it when I was over at S&P. When we bought it from Dow Jones, which was AIG before. And the thing that's really appreciated always about the broad index, it's diversified, one third, one third, one third. And when I want to compliment what Jim says, I always look at commodities, a partial exposure in a portfolio is just pure insurance. It might cost a little bit over time, but as Jim pointed out, look what happened this year. The invasion, the U.S. attack in Iran, and then Russia's invasion of Ukraine 2022. That was a great time to have some commodities in your portfolio, particularly in 2022. It said insurance, but sometimes you have to pay for insurance over time. The key theme I want to point out in broad commodities is it's also a good thing to remember is energy prices this year is driving the market for this year, but typically energies are the biggest dog in broad commodities. The Bloomberg Energy Spot Index is the same price, at least this high this year was the same price as 2005. But in a broad index, that's where I think it really makes difference for the diversification. The only major sector that's made a new high this year is precious metals. Now, precious metals are the least elastic commodities, which means they're less likely to go down after they went up, which is the major enemy of crude oil. It goes down after it goes up, but it's that protection where you need it. So what's happening so far this year, I think, is the theme I'm worried about as we started this year is you look at broad commodity market. Jim's pointed out this before too. The Bloomberg Commodity Index at the beginning of the year was almost at a 25-year versus S&P 25-year low versus S&P 500 as the S&P 500 approaches a 100-year high versus GDP. That's an environment you say, well, I got to diversify with something, at least something of value. And obviously hard assets are part of the problem, part of the solution. The key thing I'm worried about from my more tactical oriented standpoint is if the stock market goes down, almost everything is going to go down. Commodities will go down less. Because I look at volatility in gold now is the highest it's been since versus the S&P 500 since 2007. So it's no longer a store value. It's now a risk asset. Volatility in crude oil is the highest in almost 20 years versus S&P 500. Silver, gold, platinum, and palladium, corn. Are markets that look like, even Bitcoin are markets that look like they put in pretty good enduring peaks. So that's more tactical. But from long-term investment valuation standpoint, yeah, commodities might be a little bit expensive at these levels. So is the stock market. But as it starts to pull back a little bit, I think increasing allocation to commodities will make a lot of sense.
Great. And let's not ignore the elephant in the room. I know, Jim, you guys both have touched on it, but the geopolitics factor, if you will. What are the real risks here or opportunities as you see it when it comes to commodities?
Well, I definitely, and make sure, I definitely want to go there because it's such a straightforward view right now. Let's just point out the facts. The leader of the world's largest energy producer and a net exporter instituted this conflict with Iran. It's pumped up prices, and this leader is getting hammered in the polls, the Republicans are, and he definitely needs lower energy, lower inflation, lower yields or mortgage rates by the time we get to midterms. To me, that's my main tactical play. So I look at that December crude oil future, which the BCOM will be rolling to in very soon. Right now, it's $79 a barrel. I think it's more likely to be closer to 50 than 100 by the midterms. And if it's higher, well, there's your insurance, but it also means a major push against Republicans in midterms. And it's so political now. Gasoline prices have pumped, and diesel prices have pumped, and crude oil, and and corn, and soybeans, and natural gas. One thing that's really pumped and dumped is natural gas, and that's the major leader of heat, electricity, and fertilizer in the country. So the bottom line, I think, the 10 on a 1 to 10 scale for geopolitics is our leader needs lower energy prices by midterms. I suspect that'll happen. So that might be a great buying opportunity to add to more allocation.
Sticking with energy, but more as it relates to the AI boom. I'm interested in getting your thoughts there. It's a hot topic. How significant could this demand source be?
Well, I think it's very significant. The first things I think of when I think of AI is electrification, which means the two top metals on the planet for that are silver and copper. Now, copper is still in a pretty significant bull market, but I'm very concerned about deflationary forces in China pressuring that metal. And I published just recently on copper. Copper is a great metal. I love all the bullish electrification, supply demand factors, but I did point out that it is very much, it's a poor performer versus the stock market. It's very dependent on the stock market, as is silver. Silver is now an industrial metal, but they're diversified diversified in the Bloomberg Commodity Index. I think overall that's a decent allocation. Silver's made a pretty good high this year, around 125. Now it's back down below 60, so it's getting down to more attractive levels. But I'm more worried from this metal standpoint. It's my favorite sector. That's why I love that all metals index, because that's the sector that really stays up all the time, has the lowest elasticity and the best ability to really outperform the S&P 500. But overall, that sector is really dependent on the stock market. It's actually the highest correlation. And if you're looking to diversify away from stock market, metals are a bit of more the risky side, but that's part of what Jim points out. It's that diversification in the broad index is really attractive.
For sure. Jim, I want to bring it back to you. Inflation definitely on the minds of a lot of investors. And I know you've done the research here, but how have commodities behaved historically during periods of elevated inflation, and what should investors consider when it comes to this?
Yeah, I mean, inflation is one of the two main reasons why people invest in commodities. The diversification is one, but the inflation hedging benefits for commodities really stands out over time. So, commodities tend to perform well when we have high inflation, but also rising and unexpected inflation is when they really shine. So unlike stocks or bonds, commodities, they're often the source of inflation itself. Rising energy, food, raw material prices, they're directly reflected in inflation measures. And that means commodities prices, they historically shown a very positive relationship with inflation over time. The key point isn't necessarily that investors may expect inflation tomorrow, but it's the inflation uncertainty that remains elevated currently compared with the pre-pandemic era that I was talking about. So, commodities can help diversify the portfolio against risks of, high inflation where traditional assets often cannot. So that's why people look to, typically a small allocation of commodities, 4 to 9% is typically what we see in the academic literature. And that tends to do well, not only for the diversification, but also the inflation hedging, because commodities overall, they have the highest inflation beta. We have a chart of how commodities move, the BCOM moves during different quintiles of inflation, and you can see how it performs in the higher in inflation environments. So, and then if we had that with equities or fixed income, you'd see something opposite.
Perfect. Thanks for that. And Mike, you did mention the volatility in gold, but I want to bring it back to gold. A lot of investors really think about gold and that's it when they think about commodity investing. But why might that be too narrow? And what I'm also curious as to your thoughts around what happens when gold reaches new highs, and what does that look like for other commodities?
Well, first of all, I'm impressed you said when, because it's typically going to be a matter of time. First, I just want to reiterate one thing about inflation. That's the BCOM inflation beta. The CPI right now is 4.2%. On a one-year basis, the BCOM's up 29%. That's an inflation beta among 6 times. That's much better than you get from any other type of instruments, and that's where you really need it. But in terms of gold, gold's been the major commodity I've been bullish for decades. And I was in New York about a week ago presenting at the SME conference. I've been presenting there for a decade, and this is the first time I'm not bullish, because the problem with gold is it's gone up way too much. It led all the metals. It's a great leading indicator. And last year was its best year since 1979. The thing I've also learned in all commodities, there's supply, demand, and price. When price shifts at a parabolic level like that, it'll adjust supply and demand equally in a normal model and put in peaks that'll last for a long time. So I'm still bullish on gold, but I think what typically is history is an example is when you rally at this velocity, you get to a 40-year high versus your 60-month moving average, and you get to a 40-year high, almost more than that, versus a basket of U.S. Treasuries. Typically, it'll underperform for a long period of time, and that's part of where the insurance comes in. Is if it does continue, that's a substantial statement. You need that insurance. But overall, I see right now is what the problem I have with gold is. We see that unstoppable stock market. That's major demand. That's a major competition. We see that. Every country in the planet basically hiking rates right now. The ECB just did recently, and that U.S. long bond at 5%. That's competition for gold, non-income producing assets, which commodities are. So I think for now those are headwinds.
Great, thanks for that, Mike. Jim, I want to bring it back to you and back to investing. We've mentioned BCOM a few times, but really haven't explained what that is. But BCOM is Bloomberg's broad commodity index. One of the most widely followed, if not the most widely followed commodity indices in the world, with a very long track record. Walk us through this index, Jim, and the methodology and exposures behind it, please.
Sure thing. Yeah. So BCOM, it's designed to provide diversified exposure across the major sectors of the global commodity markets, designed to be a proxy for the overall global commodity markets, and includes the 6 sectors of energy, industrial metals, precious metals, grains, softs, and livestock. Currently has 25 commodities in there. Cocoa was introduced this year, and yeah, so this one is diversified across sectors, across commodities. It has 4 pillars in the initial design. One is the liquidity, which it looks at the last 5 years of trading volume for each futures contract in the commodity space to make sure that we only include the most liquid commodities markets. And then the second piece of that is that it does look at the world production of each commodity as well to make sure that we have the economic significance of the index. So the first 2 are liquidity and economic significance. And then from there, we put diversification caps and floors in place to make sure that no single commodity overwhelms the performance of the index. So no single commodity can be more than 15% when we go into the reconstitution each year for the target weights. And that reconstitution is the 4th pillar, the continuity. So the index changes the target weights and potentially adds new commodities, although it doesn't happen often, on a yearly basis. So every year in January that occurs. And most recently, because of that 10% annualized outperformance over the last 5 years, is because we've seen some sectors perform well and then broaden out to other sectors. So that tends to happen over time. Sometimes historically we get precious metals moving first, which we saw the last 2.5 years, but with gold, silver, and the rest of the precious metals last year as well. And then energy, most recently, industrial metals seem like they may be picking up. There's a few of the main industrial metals that are in supply deficits. There's been underinvestment in the broader mining space. And then from there, sometimes we see grains potentially taking the baton later. So having a diversified approach really helps with the long-term strategic asset allocation of commodities in a portfolio.
For sure. And of course, you can't invest directly in an index, but you can invest in an ETF that tracks an index. So if you're looking for commodity exposure in your portfolio, BMO ETFs recently launched back in October ZCOM, our BMO Broad Commodity ETF, which tracks the BCOM index at 30 basis point estimated management fee. So again, I think this is illustrating just the beauty of ETFs and democratizing access to some of these areas of the market that have traditionally been harder for especially DIY investors to reach. So really excited about this newer launch. Jim, close us out with your macro background in terms of how investors should think about timing when it comes to commodities in their portfolio, given all that Mike just said, a cyclical area of the market. How should they be thinking about that?
Yeah, I mean, it's like I said before, it's designed to not have any single commodity overwhelm the performance. So you're not taking any real tactical views on a single commodity. You're basically just adding a core piece of asset to your allocation in a portfolio. And there's one thing that going back to that history of that long history of BCOM that goes back to 1960. Last time we had an oil shock like we've had now was the 1960s and 70s, and BCOM performed very well. So we have a chart just showing the history those last 2 decades, and having if you had BCOM in your portfolio, would have diversified and helped with the drawdowns that you experienced during that time, but with equities and fixed income. So that's something that we look from a macro background, just see other periods in history where asset classes performed, and now is somewhat similar environment. Wouldn't say it's necessarily a commodity super cycle, but more recently, there's been some market commentary that we're in a commodity super squeeze potentially. So we've had a lot of supply overabundance in a few areas that Mike likes to write about as well. But especially with this oil shock, we're seeing inventories draw down across the board here in the energy space as well. So it's anyone's guess from a tactical standpoint where prices go, but having a long-term small allocation tends to do well in a portfolio, and it has over the last 5 years because we're in this new macroeconomic regime in the 2020s.
Mike, any final thoughts or anything you want to add there before we close out?
Well, it's particularly what Jim said and what you mentioned. It's the uncertainty. We are so overdue for a drought. Now, I fully expect grain prices to continue lower because of this wonderful thing of superabundance, but it's the risks is part of the reason you need that allocation to commodities. So I view that sector as, yeah, it's going to go lower, but I don't know what's going to take to go higher. But when it does, it's going to go fast. And that's why you have commodities. Like Jim said, you can take that, you take the escalator up and the stairs down. That's typically how they work. But overall, to me, the macro is favorable. And I'm later in the year I'm more worried about a bit of post-inflation deflation, which we typically have. But what Jim nailed was right. Last 5 years have been great. We are in the back end of probably the end of the biggest money pump in history, and we're learning the lessons of inflation. What does inflation do? It's a great way to take incumbents out of office, and that's an concurrent issue we have right now.
Okay, big thank you, Mike and Jim, for joining me today and all your valuable insights. I really appreciate it. I hope you'll come back again soon. Thank you.
Thank you.
Thanks so much.
That's all for today. Thank you so much for listening, and we'll see you next time. Bye for now.